Our webinar today is Mergers of Accounting Firms, the why, how, and with whom to affiliate. Before we begin, we need to cover a few important items. First, please close all of the programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order to receive your CPE credit, you must complete two requirements. First, you must participate in 3 of the 4 polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Next, you must complete an online evaluation. If you registered for today's webinar through Transition Advisors, you will receive a link to that evaluation in an email later this afternoon. Once these requirements are met, the certificate will be emailed to you within 10 working days. In order to fully participate in the webinar, please familiarize yourself with your GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box towards the bottom of your control panel. Just type your question in the box and click Send. Questions are important to us as we would like to address your concerns. Time permitting, our presenter will answer all of your questions. As a reminder, you received a link in the reminder email to download a copy of today's presentation. I will be sending the same link momentarily via the chat function of GoToWebinar. Now, I would like to introduce our presenter for today's session, Terry Putney, CEO of Transition Advisors. Thank you and enjoy the webinar.
Thanks, Gretchen, and hello, everybody. Just a quick little piece of information about our firm and what we do. We are a national firm. We have offices throughout the country, and we serve clients nationwide. We only focus on issues related to ownership transition in accounting firms. Those services generally fall in the categories of working on mergers and acquisitions. We do conduct searches on behalf of firms that are seeking a merger or acquisition. Looking for matches, assisting the process all the way through to closing, including structuring deals, negotiating, contract drafts, due diligence issues, and the like. We also work with firms who have found their own parties, who have found their own potential merger candidate, and we can support those transactions as well. The other big area that we're involved in is succession planning and owner agreements, helping firms that have obsolete or owner agreements that don't fit the situation that they're in right now, which is becoming more and more of a common problem. Before we get started today, just so we get an idea of who's on the line, and we have several hundred people on the line, I'd like to know, we'll launch our first polling question, which will give us some indication of the size of the firms that are attending today's webinar. So Gretchen, I'll turn it back over to you.
Okay, our first polling question is how many partners are in your firm? Your choices are 1 to 2, 3 to 8, 9 to 20, or 21 and more. We'll give it just a few more seconds. Okay.
The results are?
The results, sorry about that. The results are 1 to 2 is 68%, 3 to 8 is 17%, 9 to 20 is 5%, and 21 and above is 9%.
Okay, very good. Give us an indication of who's attending today's webinar. We'll try to direct the comments towards that audience. We're going to go through this presentation, for the most part, looking at kind of a case study. This is a typical situation that we've run into, in fact was modeled after a specific situation that we ran into. And this will give us some help, maybe give you a better understanding of the specifics of how some of the concepts that we're going to discuss work. In this particular case, we're dealing with a firm that was seeking an upstream merger or a sale, and it turns out that one partner was looking for one and the other for the other. And this is 2 partners, about a $1.8 million firm, about $600,000 in capital, which is pretty typical for that size firm. When I say capital, I mean primarily the receivables and the WIP and, you know, whatever cash reserves are kept on the balance sheet. The Frank, who's 63 years old, was looking to retire in 3 years. He owned 75% of the equity of the firm. That was determined when Frank and Alice set up this firm, you know, about 15 years ago. And as a result of, you know, all those years, he ends up, it turns out he's managing about $1.1 million in fees, and the amount of compensation he's taking out of the firm is about $400,000. Alice, on the other hand, is only 55, and she has no specific plans for retirement at this point. I mean, you know, when we talked to her, she thought probably in 10 years, but I found that anybody that's thinking they're going to retire in about 10 years really is saying, I don't know when I'm going to retire. So oftentimes that's a kind of a rolling target. She owns about 25% of the equity, manages about a $700,000 book of business, and makes about $250,000. You know, the problem was they have a buy-sell agreement, and the buy-sell agreement required that, you know, it was set up kind of the way they thought most firms would do this, and, you know, whoever retired, their capital would be paid back to them over the first year, and the goodwill value, the portion of the value that's associated with primarily the client base, would be paid in you know, over 5 years at 100% of revenues times the partner's equity percentage, and then on top of that, they were expected to pay 6% interest on the deferred payments. You know, Alice believed that since Frank was likely the one that she was going to have to buy out, that she really wouldn't be able to afford those payments. You know, we're not going to be able to go into a lot of detail today with what's wrong with that kind of a plan. I would suggest that if you have an interest in exploring that further, that you look at one of our previous webinars. The one that specifically, most recently, that we offered was on October 23rd of this year, and you can listen to a recorded session of that if you go to our website. It talks about internal succession and internal valuations. But Alice, you know, more whether I believe or whether you believe that's a good plan, Alice didn't feel like she could afford those payments. And more importantly, they really didn't have the talent on the bench to replace Frank. Alice was incapable of managing a $1.8 million firm as the sole owner, and they didn't have anybody else to bring in. This is a typical situation that we're running into all the time, and I think is primarily what's behind so much of the activity in the profession right now with respect to mergers. You know, the reasons why firms merge generally fall into two different categories. Primarily, buyers are looking for growth, and primarily sellers are looking to solve a problem. One of the things that's interesting, I think, about solving problems is that, you know, we oftentimes are working with buyers, and they'll meet a seller, and they'll tell me, gee, you know, I guess it's a good firm, but boy, they sure have this issue. And the thing that's interesting about that is, I think, well, why do you think they're talking to you? That's why, because they have that issue. For instance, obviously the biggest issue a lot of firms have right now is succession. So if you're a buyer and you're going out into the market looking to acquire firms, keep in mind that you're there to solve their problems. Now, obviously a firm can have too many problems that makes them not a good candidate, but there's a reason why they're talking to you. Most firms would prefer to be independent, and when they get to the point when they realize that the problems they have, whether it's their succession or some other issue, are such that they can't handle that anymore, then they look for someone else to solve that problem for them. But the most important thing here is to understand why you're doing this, why you're seeking a merger or acquisition, and then it's important to understand why the other firm is as well, so that you can sort of make sure you're talking to the right person who has the right objectives. You know, the standard goals that we find that most firms have for merging upstream or selling are the number one reason by far, and it's not always the reason they state, but is succession. I've dealt with firms that had as many as 25 partners who you would think wouldn't have a succession problem, but in fact had a serious succession problem. So again, I would say that by far over 50% of the mergers and acquisitions, regardless of size of firm, are driven by firms' inability or lack of confidence that they can deal with their own internal succession. The other reasons, though, that firms oftentimes are looking for upstream mergers and sales of their firm is to expand the reach of special services. So they may have developed a niche. oftentimes a wealth management niche or an industry-specific niche or something along those lines, and feel like, gee, if I could get into a more lucrative a firm with more clients that have the need for that service, then I could create a better opportunity for myself by offering that service to more clients than I can find on my own. Oftentimes maybe expanding the geographic reach, so maybe my services are only offered in Florida, and if I get involved with a firm that's more regional based, then I can expand those services beyond that. Eliminating undesirable tasks and situations, and oftentimes many of those things are administrative. We find that second and third generation managing partners oftentimes are put in that position and really don't like some of the stuff they have to deal with now, looking for someone to take that off their plate. Reducing risk, and we'll talk a little bit about that on the next slide. And then increasing the potential for professional and financial growth, which oftentimes is the goal of the younger partners in the firm who feel like, gee, you know, our senior partners are kind of in a holding pattern here, making sure that we keep things kind of status quo, and I think that's holding me back. So maybe if we merge with somebody, I can kind of break out of that mold. You know, in dealing with risk avoidance, the kinds of things that typically come up are, you know, we've got liabilities to former or to sooner retire partners. It's not that we can't replace the partners. I just feel like the financial obligation is too significant. I'm not ready to do this on my own. Specialized services that might be unsustainable. Ran into a situation recently where a partner, a firm was heavily involved in the nursing home industry. One of their partners was 100% associated with information technology services for that industry, and they had no one else in the firm that knew how to do what he did, and he had almost $1 million book of business. So, you know, as we went through their internal succession planning, it became obvious that that part of the practice had no value to them, and yet they felt like they should try to find value, and as a result, the firm is now in discussions with a larger firm about a potential merger upstream. Lease renewals, oftentimes, you know, if we're dealing with 5 to 10-year leases and the lease comes around and we've got partners who say, gee, I don't think I'm going to be here that long. I'm not sure I really want to sign on to this lease. That might be a catalyst for looking for a merger. Potential loss of key employees, become too dependent on, especially in smaller firms, on an individual, or potential loss of key clients where we might have clients that have become a significant portion of the fees, and as those clients grow, we're not growing, and as a result, we potentially could lose a significant portion of the fee base. Gretchen, I'll turn it back over for another polling question. This is the second of 4.
Okay, we're on our second polling question. Our current level of interest in M&A is experienced at M&A and currently looking, never done a deal but actively looking for one, not sure if we should do a deal, intrigued, and not sure. I'll give you a few seconds here to get your votes in. Okay, we'll go ahead and close this. Your responses are 13% for experienced at M&A and currently looking, 12% never done a deal but actively looking for one, 17% not sure if we should do a deal, intrigued, and 58% not sure.
Okay, that's a little surprising. Maybe we can help you make your decision as to whether or not you should be doing something by the end of this webinar in the next half hour or so. Let's go on to back to our case study. And looking at the firm that Frank and Alice were talking to, it was currently a 6-partner firm with about $7 million in fees, and that's a pretty typical ratio of buyer to seller. Somewhere between 3 and 6 times is generally what seems to fit comfortably in this segment of the profession. Now, if we're dealing with much larger firms as acquirers, of course, that you may find that the ratio is much larger than that. But generally in this segment, that's kind of a comfortable place of 3 to 6 times. In this particular firm, 2 of those partners were going to be retiring in 4 to 6 years, which, you know, potentially was a problem for Frank because he's thinking, well, if they're going to be leaving and I'm going to be leaving, can this firm handle it? But it turns out that the firm had a very strong bench of, 4 partners who were ready to be or 4 staff that were ready to be potentially promoted. However, the firm was having difficulty actually pulling the trigger on those 4 people because they were concerned about diluting their profit pool, and this is a problem that we run into frequently. It's, on the one hand, we know we need to bring these people in, but if we do, is that going to reduce my compensation? And one of the things that is one of the tools that's used to address this issue, quite frankly, are mergers and acquisitions, because a firm like this that isn't growing would have difficulty bringing the younger people in as partners. When you're in a mode of growth, then you're creating space for new partners, and you can keep that constant flow of talent into your partner level flowing. And that's one of the reasons why this particular firm was motivated to look for mergers and acquisitions and ran into Frank and Alice. The standard goals for firms that are interested in growing through merger or acquisition on the buyer side are generally for growth, and primarily what they're looking for oftentimes is a pure growth in billings. I mean, we just need to get more top-line growth, and firms that are in this segment of the profession, this segment of under 10 million, oftentimes struggle with practice development. It might depend on 1 or 2 people in the firm to bring in most of the new business. If those people aren't there anymore, or there may be one of the senior partners that's leaving, then there can be a concern about whether or not we can sustain top-line growth. Oftentimes, looking also for additional talent and services. We've got a lot of construction clients. We'd like to add in a firm that does some higher level work for construction clients, or potentially clients that we can cross-sell to. So we offer those kind of services. We need to have more construction clients to offer those services too. We see a lot of geographic expansion for firms that are trying to build their brand and extend their brand to a higher level. I think that's definitely what's happening at more of the national level with the firms in the top 25 who are racing to not only increase their standing within the top 25 list, it's, the different lists that are released locally and nationally, but also if your firm is going to call yourself national, you pretty much have to have an office in certain markets. Obviously, New York, Chicago, L.A., Dallas, somewhere in Texas, usually Dallas and Houston, potentially Atlanta, and so forth. So there's a definite objective of filling in the map for some of the firms at that level. But even at the regional level, being able to offer themselves out as a multi-office firm increases their stature within the market. And then, of course, again, as I mentioned, strengthening the succession team, which in fact was the objective of this particular firm that was the acquirer in this transaction. When we look at the types of deals that are done, generally they're going to fall in one of these 4 categories. An outright sale, and we'll talk about each of these immediately following here in detail. Outright sales, what we call 2-stage deals, and call-out sales, and then what's the difference between a sale and a merger. In an outright sale, this is the way most people think when they enter into transactions. They think this is how you do it. I mean, you sell your firm or you buy a firm, and this is what it looks like. And off the top of your head, it makes the most sense. I'll buy if I'm a buyer, I'll buy the practice, and after a short transition period, the seller will exit the scene, and I'll take over, and the clients will I'll start servicing the clients, and start making money right away off this deal. If you're a seller, I mean, it seems to make sense that you would start getting paid for your practice as quickly as possible. If I'm going to sell my practice, why wouldn't I get paid for it right now? The buyer wants the seller and his costs out of the way as fast as they can. So all of this seems to make sense financially for both parties. Think about it, though, just when the seller's unique talents are most needed, which is at the point in time when the clients need assurance that the new firm is the right firm for them, the seller's now exiting the scene. So one of the problems with outright sales is that if we want to keep the seller involved in the practice, how are we going to pay that person while they're also being paid for the practice? How can we afford to do both of those things? And typically buyers don't do both of those things. They look at minimizing the compensation, which creates a disincentive for the seller to work and keeps the seller from participating in the practice transition as much as they should. And it also creates, because there's tension, financial tension in that part of the transaction, it creates the need to shorten the transition time to maybe less than what's really effective. So as a result, we tend to favor more of a two-stage deal approach. We've written quite a few articles in the Journal of Accountancy about this approach. You can find those articles on our website. You know, stage one is generally a period of 2 to 5 years. We start the transition process with the seller during stage one. And so the clients are staying, the seller's actively involved on a full-time basis with the client base, and but the seller's now operating usually under the umbrella of the buying firm. The seller will maintain reasonable control over the clients and their services, will take on a principal's role or a non-equity partner role as far as the outside world's concerned. They're a partner in the firm, and usually are maintaining their compensation rates. So during stage one, which is this 2 to 5 year period, we are basically 100% focused on creating a very effective and powerful transition of the client base. This is the actual, this is the way that we approached Frank's deal with the firm that acquired him, and we'll talk about that in a minute. Stage two then becomes the period of time during which the practice is paid for, and that kicks in at the end of stage one. So if we've got a 3-year stage one, we're going through a 3-year transition. Stage two is when we start paying for the practice as the buyer, when the seller starts receiving the payments. The transition, the seller, if they stay on, and they oftentimes do, it's usually in a part-time role. They're oftentimes paid on a per diem rate for billable hours. But the most important thing is that the purchase is now based on a practice that has already transitioned to the buyer. So that the fact that the seller has now, maybe left the scene altogether or is now in a very much reduced role has become a non-event for the clients. The clients have already made their decision that they're going to stay with the buying firm. So the risk associated with the transition, which can lead to poor retention, potentially has been almost eliminated from the transaction. As a result, the value of the practice is maximized for both parties. A call-out sale is a sale where we're selling a portion of the practice, oftentimes most of it. Typically what might be retained by the seller would be a segment of clients. We might have, for instance, a particular client that the seller fears that is not going to transition under any circumstances. Might be family. If the seller has a significant portion of the practice that's associated with family members, they might keep that. There might be certain clients that are in a certain profession. For instance, I've had firms that did quite a bit of peer review, and the acquiring firm, quite frankly, didn't want to do peer reviews, and the seller liked doing those, and so that portion of the practice was carved out. Sometimes we're dealing with locations. We might have a satellite office. An example was a firm I worked with that had 7 partners. 6 were located in a major metropolitan area. 1 was located several hundred miles away in the same state in a much smaller community, and that partner was the one that was looking to retire. So because nobody wanted to move to that satellite office, we found a buyer for that practice in that community. And that particular partner then became part of that firm in a 2-stage deal, and in essence it was a call-out sale for the overall firm. The difference between a sale and a merger is in a sale, which a 2-stage deal is, the selling party typically does not become an equity owner in the buying firm. Now there's some exceptions to that for immaterial amounts of ownership. I'm working on a deal right now where we're wanting to introduce the name of the selling firm into the name of the buying firm because of a variety of issues. That doesn't normally happen, but in this case it makes sense. And in order to do that, we need to issue a very immaterial amount of ownership to the selling partners so that their name can be used in the firm's name for a period of time. But typically the seller does not become an owner in the firm. One of the key things to look at from a valuation perspective for the firms that are the partners that are merging in is that your value in that transaction is dictated by the acquiring firm's owner agreement. So I oftentimes get questions of, well, what are firms going for in mergers these days? And of course the answer is, well, it depends on the firm you merge into. I mean, if the firm has a 2 times compensation arrangement, that's going to dictate what your value is. If the firm pays based on 100% of revenues, that's going to dictate and depending on what your ownership is, that's going to dictate your value. So it's important to make the distinction between what's a sale and what's a merger, and understanding what's in it for the seller. With that, Gretchen, I'm going to turn it back over to you for the next polling question.
Thank you, Terry. This is our third of 4 polling questions. In the next 5 years, my firm is likely to acquire a smaller firm, merge with a similar sized firm, merge into a larger firm, sell, or not sure. I'll go ahead and give you a few seconds to answer that question. Okay. We'll go ahead and close this polling question. And your answers are 19% acquire a smaller firm, 3% merge with a similar sized firm, 6% merge into a larger firm, 6% sell, and 65% not sure.
Come on, you guys. Commit to something here. We shouldn't have left the not sure in there, I think. We got too many people saying that. Okay, so getting back to our case study. The way that we solved this deal was that Frank was bought out using a 2-stage deal, as we previously described, and Alice was admitted as an equity partner, which meant she signed on to the acquiring firm's partnership agreement. So, in this case, because we have differing deals like that, and everybody's not in lockstep, and that's usually the way it works. I mean, normally we've got partners that are on different time frames for when they're going to retire, even if they're all coming in as a 2-stage deal. Usually we have to deal with, separate transactions because somebody might be leaving in 3 years and somebody in 5 years and somebody in 7 years or whatever. So we've oftentimes have to bifurcate the transaction for that reason. Fortunately, in this case, Alice's and Frank's books of business, this was easy to do because they kind of ran them separately. They were almost like they were sole proprietors sharing offices. And fortunately, with Alice owning 25% of the practice and Frank owning 75%, the books of business lined up somewhat around those percentages. Now, there was about a $250,000 differential, as you recall. Alice was managing a $700,000 book, and Frank was managing a $1.1 million book. So there was a difference between what Frank and Alice thought of, or at least what Frank thought of, is what he owned and what he was actually managing. In this particular case, we worked that out between Frank and Alice with having a transaction on the side between them that shifted some of Alice's compensation over the next several years to Frank in order to buy out, basically equalize. And it wasn't a lot of compensation because Alice wasn't too interested in taking a cut and pay. But in order to sort of kind of catch up with what they maybe should have done years ago, that's how they dealt with it. As a result, we now can tie Frank's buyout to his book of business, and Alice can tie the equity that she's contributing to the acquiring firm based on her book of business. So Frank's transaction looked like this. I mean, in stage 1, which was agreed would end in 3 years, now it could end sooner if Frank was to become sick or die or even just wanted voluntarily to end it sooner. He had the choice of doing that. Well, what it meant was that his stage 1 couldn't go beyond that 3-year period. His compensation was tied to his historical comp by paying him 35% of the collections from his clients from his book of business, and that included all of his perks and benefits, which is about what he was making before. It turns out if he used more labor than he historically had, which probably would happen either because the practice grew or because he decided to work fewer hours for himself, then there would be an appropriate adjustment in the compensation rate so that the acquiring firm wasn't expected to supply those additional resources with no cost, with no reimbursement for cost. So Frank's primary objectives in stage 1 were to smoothly transition his clients to the new firm. We usually think that it takes about 2 years to do that. Maintain the relationships and the fees. Gradually introduce the clients to the specific successor in the firm. Make the day that he left or he retired a non-event for the clients, and at the same time maintaining his income level. Frank's stage 2 was basically because he had kept his receivables, his portion of the receivables in WIP, and that was roughly 75% of the receivables in WIP. Because he kept that at the beginning, then at the end of stage 2, all he had left to do was to get paid for the intangible portion of his practice. He was paid based on collections over a 6-year period, replicated the kind of deal that he would have received if it had been an outright sale, which of course now we're talking about this kicking in, though it's at the end of 3 years, not at the beginning. And Frank was paid separately for the new clients that he was able to generate during both stage 1 and stage 2. So those new clients weren't included in the purchase price, but he was paid a commission rate which was based on 10% of the collections from the new clients that he'd introduced to the firm for the first 2 years they were a client. That was the incentive that Frank got. When we talk about value, and we'll talk about what Frank actually got paid here in a minute, when we talk about value, it's important to understand what really creates value for a practice. Oftentimes, unfortunately, a lot of sellers think of value as sort of like the way they would on what a bushel of apples is paid for. Well, I've got this client list, it's a $500,000, it's $1 million, whatever it is, book of business, and therefore isn't it worth X times that number, without really thinking about what creates that value. It's important to understand that the reason why that practice has any value at all is the seller's ability to find a buyer who can reasonably take over the practice and the seller and buyer successfully execute a transition plan to transition the client relationships from the seller to the buyer. So it's important to have that business plan and that concept backing up the value. Once you've established that that's a likely outcome, now we can talk about what to pay for that. The things that affect value are many, but one of the issues that's very important is the deal terms. So there's 5 different deal terms that sort of fit together in the way deals are put together, and how these fit together determines what the quote value of the practice is or the price of the practice. So one of the issues is cash up front, if any. It depends on the time of year we're talking about. If you're a seller and you're selling in an outright sale, you're more likely to get a bigger down payment in December than you are in May when you've just taken all the profits out of the practice. You may get nothing in May, whereas you might find somebody to give you 10 or 20% up front in December. The deal's cash flow, how well the practice cash flows and how you're going to treat the receivables. I mean, keep in mind that most buyers, if your receivables run 20 to 25% of your volume, the buyer's going to have to replace that if you've kept those receivables. So sometimes we're able to negotiate a deal with some upfront money when the receivables are rather than retained all up front by the seller, or maybe we allow the buyer to use those for a year or two. The retention is the second issue. How much is the retention going to affect the deal, and how long is that retention in place? The different ways that this works are, a collection deal obviously is a deal that's paid as collections are made over the period of time that the payments are made. So if we've got a 5-year deal, if it's 20% of collections for 5 years, that's a one times multiple. A fixed deal, which is very uncommon, would be where we set the price at closing. Hardly ever see that. Limited guarantees are where we have less than the full payout period, or usually less than a 5-year payout period for the guarantee of the retention adjustment. And then an economy clause is a technique that's used to separate why clients leave, and if a client's leaving because of something that nobody had any control over, then it still affects the purchase price. But if they left because of some other reason, For instance, if a client goes out of business, no one had any control over that. But if the client leaves because of a service issue, then you might deal with that retention differently. The profitability of the practice is a factor. When we talk about profitability, we're primarily talking about the buyer's anticipated profitability. I would throw out this example. If we had a sole proprietor who was working out of his house, his wife answers the phone, he generates, say, $400,000 worth of business, and he does all the work himself, then it changes and he makes an 80% profit margin. He then decides, well, I don't want to work out of my house anymore. My wife doesn't want to answer the phone anymore, and I'd like to work less, so I'm going to hire somebody. And now his profit margin goes down to 35%. At what point in time was that practice worth more to the buyer? Well, of course, it's worth the same both times, and it's the same client list. So oftentimes the seller's profitability isn't as important as looking at the buyer's anticipated profitability. The way the deal is structured tax-wise obviously makes a difference in the after-tax cash flow. That can affect the profitability. And then the fourth item, of course, is the length of the payout period. How long are we going to be making payments to the seller? Is the buyer going to be making payments? The multiple then is the effect of all those four other terms. So if we have a large down payment, we have a short retention period, we have a deal that's not so profitable for the buyer, maybe because it's done as an asset deal, which requires the payments to be amortized over 15 years, and we have a short payout period, so we've got a 3 or 4 year payout period, then you should expect the multiple to be much lower than if all those factors are going the other way. So it's all a cause and effect, and everything fits together. I'm going back to Frank's buyout terms because of the way the transaction was structured, and it's not unusual in two-stage deals for there to be no down payment. There was no down payment. The parties in this case were comfortable because of the way that they felt the transition was going to go with respect to Frank's clients, and as a result they were willing to lock the price in after 3 years. And so for the first 3 years, Frank was paid 1/6 of his collections for the purchase price. And again, remember, this kicks in at stage 2. And then the price locked at the end of the 3 years, and there's a variety of ways to do that. And we won't have time to get into how to do that here, but just imagine that at the end of 3 years we know what the full price is going to be. And the remainder of the payments were made over the next 3 years. The deal was treated in this case as 50% asset, 50% consulting. Actually, the parties came to the table with Frank expecting, hoping for an asset deal, and the buyer hoping for a consulting deal, and we managed to find a common ground in between, going 50-50. So in essence, Frank was paid 1 times his book of business for the practice, and but the multiples will vary depending on the market and other considerations. In very large markets like New York, we're still seeing deals done at over 1x. In smaller markets, especially very small markets, it's sometimes so difficult to find a buyer that it's not a reasonable expectation to get that much of a multiple. So it just depends on the market you're in, the type of practice you have, and really it's a matter of supply and demand. In markets where you're likely to have a lot of buyers that might be interested, you can expect usually a higher multiple than in markets where you have fewer buyers. Alice, in this case, signed on to the partner agreement of the acquiring firm, and her compensation was, as a result, conditionally guaranteed of $250,000 for the first 2 years. She received, basically a portion of the equity in that firm based on her relative revenues. In this case, that worked out to 9%. She got a 9% equity stake, and she contributed all of her AR and WIP, which was 25% of the firm's AR and WIP, as her capital contribution. Otherwise, she became bound by all the terms and conditions of the firm's agreement. So her eventual retirement will be based on that firm's owner agreement. So with that, we're going to go into, I think this is our final polling question.
Yes, this is our final polling question. The most important thing in my mind in an M&A is the financial terms, the cultural fit of the parties, or retention of the acquired clients. Just a few more seconds here. Okay, we're going to go ahead and close this question. And your results are 23%, the financial terms, 32%, the cultural fit of the parties, and 45% retention of the acquired clients.
Okay. And of course, I'm sure all of you wanted to answer all three, but we made you forced you into what was the priority here. So, okay, so if you're a seller or a firm seeking an upstream merger, it's important to identify what makes a good buyer. And generally think of the 4 C's. We're talking about culture, chemistry, continuity, and capacity. You know, culture means primarily, you know, birds of a feather flock together. If clients were attracted to your firm as a place to provide services, then the firm that you merge into hopefully will provide a similar culture for those clients so that they'll want to stay. If it's so dramatically different, you know, that can hurt client retention. Chemistry, of course, is more of an issue of how you get along with the other people in the firm. One of our rules of thumb is after having a meeting or two, if you can't imagine yourself having lunch with the person across the table on a regular basis, don't do a deal with them because the chemistry's wrong. Continuity, we're talking about here is will the firm accommodate a gradual transition of the practice, because we're trying to create continuity for the clients. As little change as possible up front, but over time, obviously, those clients have to become clients of the acquired firm. And the capacity to take over because oftentimes we're dealing with succession. If you have partners or you yourself are leaving, making sure that they have the capacity to replace you within the firm, either with, you know, primarily with other partners. And it doesn't necessarily have to be somebody that's there now, but they have the idea and the concept in mind of how they're going to replace you. Again, if you have specialties, making sure they know they can replace their specialties, certain technical skills. The size of the firm matters. I mean, if you're a very small firm merging into a really large firm, sometimes some of the 4 C's come into play, the culture and chemistry, for instance. Location can make a difference. If you have clients that are used to coming to your offices and all of a sudden they've got to drive 10 or 20 miles further, that can be a problem. But, you know, what we're finding nowadays is that most client bases are served in a virtual manner, and so the location becomes less of an issue. And don't make it into a big issue if you don't have to, because the less restriction you put on the location, the more firms that are going to become relevant that you can talk to. Technology, of course, you know, what kind of technology changes is everybody going to have to go through? As a seller, remember, you are what you are. However, whoops, what happened here? Okay. Buyers hate inheriting problems and poorly run practices. So, you know, clean up your AR and WIP. If you've got a bunch of old AR and WIP, you know you're not going to collect, get it off your aging. I mean, that indicates potentially a problem for the buyer in terms of your clients, that you have poor clients who don't pay well, when in fact it may just be something you've never had the guts to write off. Present your partners and staff in a positive light. You know, these are part of the deal. I mean, part of what's being acquired are the staff and the partners. You know, considering jettisoning problem staff. You know, coming to an issue and saying, gee, I've never been able to deal with so-and-so. You know, he's really hard to deal with, or he's got this issue, and I'm hoping you can do that for me. If you can get rid of that person in advance, that's better. Clean up your office. Eliminate clutter. First impressions are huge. Provide good time records. The smaller your firm, the less likely it is that you have good time records, because you don't need to know as much to manage the practice as a firm that's larger. But firms that are larger, that's how they run their practice. So if they see you not having time records, maybe you've got partners that don't put their time in, or don't put it in timely, but expect the staff to, then they're concerned that that's going to happen for them as well, and that's how they manage the practice. And be willing to part with your unprofitable clients. I mean, oftentimes your unprofitable clients are the ones that will taint the whole practice when they might in fact be a very, very small portion of the practice. An example, you've got a bunch of $250 1040s, you might have, you know, 100 of them. And, you know, a buyer looks at that and goes, gee, I can't imagine doing 1040s for $250. There's no way I'm going to do that. I'm not sure I'm interested in this practice. Well, it turns out it's $25,000 worth of business. And, you know, if you've got $1 million practice, you know, that isn't going to make a difference. But unfortunately, it taints the buyer's expectations or view of the practice. So sometimes either getting rid of those or making a statement right up front, gee, I know you may not want this, but don't worry about it. We'll figure out a way to get around it. If you're a buyer, defining a good seller, If it's an acquisition, it should mostly be about the clients you're acquiring, the staff you're acquiring, and the economics of the deal, even in a two-stage deal. You're not creating a long-term partner relationship. You don't have to worry so much about cultural issues. However, if you're dealing with a merger, then culture becomes very critical. When we talk to firms that have had failed mergers, they almost always tell us the number one reason was a cultural problem. But the problem we have is oftentimes defining what culture is. I mean, it feels like a look and feel kind of thing. We walk in the office and say, gee, this feels like a good culture, but in reality, look at culture in terms of these three different areas. Organizational issues can also be defined as what's it like to work in this firm, as an employee in this firm? What's it like to, how's the firm operated? How's that going to affect me as that's a person that's part of this team? Client service issues. How are clients served in this firm? What's it like to be a client in this firm? What's the client experience? How are services provided? How are fees billed? At what level are fees billed? Those are all issues that fall into client service issues and part of this, that part of the culture. And then finally, partner issues, which are what's it like to be an owner-employee in this firm? How am I going to be paid? What's the owner agreement dictate? What are the values this firm has in terms of partner performance? How much accountability will I have? How do we govern the firm? All of those things fall into that part of culture. The things that make you an attractive buyer, if you're buying a firm, these are the things you want to demonstrate to every seller. The most important thing for me is that I'm going to keep all your clients. Even if you've got clients they're going to be difficult, at least be sympathetic to the fact that that's part of the value of what the seller is bringing to the table. We're going to minimize change, especially up front. Doesn't mean that we're going to do things the way you've done them forever, but we understand that change is difficult for you, your staff, and your clients, and we're going to make sure that it doesn't have a negative impact on the firm. And then in terms of terms, if you're out looking for low-ball deals, you want to find the cheapest deal possible, keep in mind that you're selling to somebody who was willing to accept those terms. Oftentimes, the low-ball deals are deals you do with the worst potential sellers. In mergers, again, is looking at it from the standpoint of what's an attractive buyer. The things that are important that you have to be able to articulate to the partners in the other firm are the owner agreement and how that works and how it's going to impact them. The compensation system that you have, the more subjective your compensation system, the more it's determined, for instance, by an executive committee or a managing partner, then the more risk that potentially presents for the partners that are merging in because they don't know the basis for how those decisions are made. So that's the reason why a lot of mergers have 2-year conditional guarantees in them of compensation for the first 2 years. Long-term strength, especially succession, understanding, again, keep in mind, going back to Frank and Alice, that the firm they were merging into had 2 of their 6 partners that were leaving in the next 4 to 6 years, and that was an important issue for Frank and Alice because what they saw was turmoil. Well, once they became comfortable that there were 4 new partners that were going to come in behind those, that took some of that risk off the table. So understanding that your succession issues, where you may feel like they've been dealt with, make sure you're ready to discuss how they're going to be dealt with this potential seller. And then, of course, being able to create upside potential. Anybody that merges in typically is looking for a better outcome. So how are they going to achieve that? This is a good checklist. You've all got a copy of this presentation. I suggest you keep it because this is the thing that we found. The best buyers are able to be clear and concise in their goals. They're good communicators. They stay in touch with all the parties on a regular basis. They're good listeners. I mean, the worst thing you can do is get into your first meeting with a potential seller and all you do is talk about yourself. People like to talk about themselves as well and want to let you know what they know, how they feel about their firm as well. They're visionary about the firm's direction. They know where it's headed. They're able to promote flexibility in the way that they deal with all the terms, their business plan, sympathetic to the seller's point of view. They have a sense of urgency to keep the deal moving. One of our rules of thumb is time kills all deals. The longer it takes to do a deal, the less likely it is going to happen. And they stay in touch. If let's say you've had a meeting and then you don't get back in touch for 3 weeks, that's an eternity for a seller. So staying in touch and creating a sense of urgency on both sides. They have, and they demonstrate the fact they have capacity to replace the seller. They're compassionate about the seller's transition and what they're going through. It's the most important professional and financial decision they'll ever make. And then they have also the capital to finance the deal, and they've thought that through so that they're not trying to squeeze as much as they can out of the terms in order to finance the deal. This is additional, these are additional webinars on our website that you might want to refer to on issues related to today's presentation, as well as I mentioned before, this October 23rd webinar talks about deals, issues focused on internal transitions. Thank you for your attention today and your participation, and I'm going to turn it back over to Gretchen to wrap things up.
Terry, I do have 2 questions if you have them.
Okay, I lost my control screen, so tell me what they are, please.
Okay, the first one is, what makes a successful compensation arrangement for the selling partner? Fixed % of collections, hourly rate. How does it work for smaller versus medium-sized firms?
Okay, what was this? What % of collections and hourly rate?
It says, what makes a successful compensation arrangement?
Okay, I think that, again, in a 2-stage deal, typically what we're trying to do is replicate, you know, the level of compensation that the seller had prior, assuming it's reasonable. I mean, if there was a 70% or something, we have difficulty oftentimes finding a buyer willing to do that. But let's assume that we're dealing with something that's at a reasonable range, say 35 to 40%. Oftentimes, because of the other issues associated with what we're trying to accomplish, tying compensation to a percentage of collections makes the most sense. Because that's really what we're trying to do is maintain the business and maintain the profitability. On the other hand, if you're moving to a situation where it's more about what your role is going to be going forward in the long run, it may make sense to go to more of an hourly type arrangement where we're not so concerned about you continuing to manage a book of business, or you know, a lot of that's going to be taken over by the buyer. So it really depends on what the business plan is for the transaction as to whether it makes sense to go hourly or on a collection basis. But keep in mind, if you're going to pay somebody for hourly, you know, hourly, for instance, for billable hours, that's what they're going to do. They're going to focus primarily on generating billable hours, and that may be at the expense of something else. What's the second question?
The second question is, what determines whether the sale is treated as an asset sale or a consulting agreement?
It really is. It's just negotiated. It can go either way. The terms can be identical otherwise. It really just depends on what the parties agree to. I will say that the longer the payout period, the easier it is to find a deal that's asset-based. So if we're dealing with, say, a 10-year payout period, then, you know, the difference between 10-year payments and 15-year amortization are not as significant as a deal that has a 5-year payout period. So a buyer might be much more inclined to go along with the deal being treated more as an asset deal with a longer payout period. But usually we're just talking about, this is one of the areas where it's either in my pocket or your pocket. Needless to say, a buyer would prefer to deduct the payments as quickly as possible. That makes the deal less expensive for them. A seller would prefer to pay less tax, makes the deal more valuable for them. So it's not unusual for us to have to try to negotiate a compromise. Sometimes deals are done 20-80, sometimes they're done 50-50. A lot of deals, though, I think there's still the majority of deals that we see are still done as consulting arrangements and deductible as paid, primarily because they have short payout periods of usually 5 or 6 years. Any other questions?
No, those are the only questions I've received so far.
Okay. You want to wrap it up with them then?
All right. Well, we would like to thank you all for attending our webinar today. I would like to remind you that to get your additional CPE credit, that if you have registered through Transition Advisors, you will receive an evaluation in an email later today that will need to be completed. Also, you can find more information on our website, transitionadvisors.com, and please feel free to contact us through there. Thank you all for attending, and have a great afternoon.